What's up, everybody? Something a little bit different for you on this Monday because, whoa, Zoom just zoomed in. I get a lot of questions of what's the rate forecast going to look like? What is this going to be? So I was honored to be presented an opportunity to present at an economic forecast. So I thought, gee, I might as well share those slides with everybody that watches. So you've got the data that I know. So let's figure out if I can share things, all the things, and let's make this happen. So, alrighty, when we're talking about mortgage rates overall, we've really got to pay attention to what's happening behind it, right? So this is going to be strong economic forecasts. It's not lenders that are setting this, it's really the economic overall. And then for realtors, they just need to understand what these drivers and how this works, right? So again, this was a presentation I asked to present for a realtor company nationwide, and I'm giving it to you. All right, so what does that actually mean, right? So they don't really exist in a vacuum. It's not like rates are going to go up, rates are going to go down. So there's three big things that we need to focus on, right? So the first one is inflation trends. So fun fact, every single month the consumer price index report comes out. Every single month there's a lot of economic data. That's the biggest one to watch though, because it's saying where are prices changing? Do we still have inflation? And sustained disinflation creates conditioning for lower borrowing costs. Now, that doesn't mean deflation, where it's going backwards. It means that it's stabilizing and that it's not growing as aggressively, right? So, number two, Federal Reserve policy. We all know that we're getting a new Fed chair next year. I don't think that they're going to see any changes until at least probably Q2 because of this. They got to get together, they got to talk to the people. But the further rate cuts signal economic confidence, right? Like we got to put a little bit more money into the market, right? This is okay. While pauses can say like there's caution about inflation because we don't want things to inflate too much. Because if they put more money in the market, prices could continue to rise, right? They want to put money in the market to get people to spend money. Now, the 10-year treasury is the main way that you should always be watching mortgage rates, right? Like everything else is fine. This is the real data pull. Because think of it, this is investing in your life for a decade at a time. And the 10-year treasury is investing in America for a decade at a time, right? So rates aren't necessarily guaranteed. Macroeconomic stability, right? The whole world. Fun fact, I listen to France Interdit radio at least once a week so I can keep up on my French. And I was listening to this article today or this conversation to say about China becoming the new green player in the market, right? That is a macroeconomic stability that could impact rates overall, right? So even though we all want them to drop, some of these things may actually make them increase. So what does this mean, right? So we've got Fannie Mae, that is a really big buyer of mortgages on the secondary market, right? Those are conforming loans. And they feel that we're going to see about 5.9 at the year end, not the beginning of the year end. They think we're going to be stable at with a five in front of it. The MBA, which is the Mortgage Bankers Association, are around 6.5, right? So they're more conservative. Fun fact, Fannie Mae has been aggressive in their rate predictions, and they've not come true the past couple of years. MBA has been a little bit closer, but over a market consistence, really think that this is going to be that corridor depending on the data that comes out. So don't expect things to drop to 3%, right? Because what this means for business overall is the mid six rate environment is going to be more normal, going to be unstable. And we're going to see probably some increased market activity because demand moves faster than supply. And I'm already talking to people that be like, oh, rates are where I want to. I'm simply going to buy next year because it's the holidays, et cetera, et cetera. And we have to keep in mind that there's still a lot of levers that sellers can pull and you can pull as a buyer that's going to offset some of the higher interest rates. Because if we see rates drop, then prices are most likely to increase, and that's just going to keep pushing the needle. So we've got to address this affordability in your mortgage plan. So summarizing everything, optimistically, we're thinking just under 6%. I can't even believe it's going to have five in it. But as long as inflation continues to cool down, it should be fine. We expect stronger buyer demand this to come, a robust refinancing wave, which means that people are most likely going to be staying in their homes versus feeling forced to shell, right? And increased inventory as rate lock, sellers feel comfortable moving, right? So Number one, I can refinance it down. Number two, all right, I need to downsize or I need to upsize, and I couldn't afford the next property, but now that that's cooled a little bit. So, best case is really rates holding in the range that they're on now, right? The low to mid sixes, and then pessimistic that they might even rise. Now, nobody wants to hear me say that the rates might actually rise, but this could be the reality. So, we need to have these conversations about long term scenarios. We need to keep having these discussions. Rates are such an important factor, but the bigger strategy and overall view of your financial health is what is really key. So, let me know what I can do to help you or anyone else. Let's all be nerds together. Go team. And we are still fingers crossed that rates do come down in the fives. I'm just going to be real about that. I'll talk to you soon. Bye.